Hello everyone, welcome back. My name is Arias, and today we are going to be doing a deep dive into what Lemonade's new synthetic agents are, what problems they solve for Lemonade, and how it will affect their business going forward. Let's start off by talking about what problems synthetic agents solve. Lemonade has an excellent lifetime value to customer acquisition cost, or LTV to CAC ratio, of greater than 3. This means that for every dollar they spend in acquiring a new customer, on average they get $3 back. This is a great deal and enables a 50% internal rate of return, or IRR, which accounts for the time value of money. However, there lies a problem in that Lemonade spends the full customer acquisition cost upfront, but gets the payback from the customer over their lifetime. This creates a short-term cash crunch where $1 spent today on acquiring a customer won't again be available to acquire another customer for 2 years. Lemonade, like all businesses, has a limited amount of capital, and because their opportunities are so plentiful and capital is limited, Lemonade is forced to forgo profitable business, and this is exacerbated by the cash flow gap. Now enter synthetic agents. Synthetic agents are a new type of financing for Lemonade. They are named synthetic agents because they fulfill a similar function as traditional insurance agents. Traditional agents acquire customers for insurance companies with zero cost upfront to the insurance company, avoiding the cash crunch problem that Lemonade currently has. However, those companies have to deal with these traditional agents taking a 10 to 20% commission, which is a large part of the gross profit from each customer they onboard, and this is in perpetuity. In Lemonade's case, similar to a traditional agent, General Catalyst, a VC firm, will provide capital upfront, enabling customer acquisition while avoiding the short-term cash crunch. In return, General Catalyst will receive a 16% commission from the premiums they help finance. Now, this is where it's different from the traditional agent structure. Once General Catalyst has recovered their initial capital and a capped 16% internal rate of return, then Lemonade keeps the lifetime value of that customer. However, if the premiums from a particular cohort stop before General Catalyst gets their full capital and return back, they take the loss. This is where it really differs from a loan, which is the main criticism I've seen so far from bears. This significantly de-risks the arrangement for Lemonade, as if a particular cohort doesn't work out, they aren't on the hook for the capital. It also shows General Catalyst's confidence in Lemonade's economics to accept the loss if Lemonade is unable to get these customers to stick around long enough for them to pay back. The other way this differs from regular insurance agents is that General Catalyst is not actually doing anything to acquire these customers, but is simply providing the capital to Lemonade to go out and do so using their DTC channels. In the announced deal, General Catalyst provide Lemonade with up to $150 million, and this will finance up to 80% of Lemonade's customer acquisition and will take place over the next 18 months. This will allow Lemonade to continue to grow in this cash-strained environment without depleting cash stores as quickly. So what does this do for their business? Like I said before, it starts to solve the cash crunch problem. This will massively increase their efficiency, as management is expecting Lemonade's IRR to jump to 90% with synthetic agents from 50% prior to their introduction. Lemonade and General Catalyst intend to adjust, renew, and upsize the agreement as they learn from the current one to fully maximize Lemonade's business. This is great news for Lemonade investors, as my biggest worry has been their future growth given the current slowdown. This slowdown has been for 2 reasons. First, inflation has severely impacted Lemonade's unit economics. Over the past few years, we've seen inflation stay higher for longer than we've seen in recent memory. And because the cost of a claim is instantly adjusted for inflation, but rates take time to filter through regulatory approvals, a gap has emerged that hurts Lemonade's ability to acquire new profitable business. This will be solved over time as their rate changes are approved, so in the meantime, they've slowed customer growth to avoid losing more money on unprofitable customers. The second reason for the slowdown is because the market is assigning Lemonade a lower valuation, making it more difficult for Lemonade to get money on terms that they like. This has forced them to assume the capital that they currently have is what they will have in the foreseeable future. This leads them to moderate growth with the intent of extending their capital to be self-sustaining. Synthetic agents go a long way to help solve this problem. They provide the capital that Lemonade needs now so that instead of being a drag on cash levels, new customers turn into gross profit generators much quicker. Before this deal, Lemonade had to spend all of the customers' acquisition cost upfront to get customers, who will finally start generating cash to them 2 years later. Now, all they have to do is wait for the customer to pay back the 20% of the customer acquisition cost that Lemonade is fronting before they turn into a gross profit generator for the company. This isn't all good for Lemonade because they do have to pay General Catalyst their return, which equates to paying extra for customers overall. Lemonade is essentially paying General Catalyst to keep their cash available to them, and I'm okay with this trade-off given the current market conditions. But I would expect Lemonade to try to fund as much of their own growth as possible once their capital position improves. Speaking of improved capital positions, because of the way this deal pulls gross profit into the future, Lemonade's management now expects unrestricted cash levels to be at least $200 million in most scenarios. This is up from $100 million prior to Synthetic Agents deals and remains true in both high and low growth scenarios, with profitability coming in a similar timeline as well. The rate adjustment issues impairing short-term unit economics will keep growth rates slowed for some amount of time, but management said they would look to catch up to their multi-year target growth rates of 20 to 25% once their due rates are approved and implemented. Overall, this deal makes me really excited for Lemonade. I want to see them maximize their growth, and I think this will certainly help them do that. For more on Synthetic Agents, check out Lemonade's press release and CEO Daniel Schreiber's blog post. I covered most of the information, but it's always better to go to the source, and I'll link those in the description. Another great resource for Lemonade investors is the Paper Bag Investor, whose video on Synthetic Agents I will also link below. Now let's go over some of Lemonade's Q1 report before we get into my big picture takeaways for Lemonade. Lemonade reported Q1 in-force premium of $653 million, up a respectable 56% year over year. Remember, only 32% of this growth is organic, as the Metromile acquisition is still being lapped year over year. IFP growth was made up of a 26% increase in premium per customer to $352, and a 23% increase in customer count to 1.85 million. These are both respectable numbers that are getting temporary boosts from the Metromile acquisition, which I'll be interested to see what they revert to once the acquisition has been fully lapped. Also important but not listed are operating expenses ex policy losses, which grew just 4% year over year, showing strong operating leverage. Gross loss ratio was 87%, an improvement of 3% year over year. This is still rather troubling, as investors would like to see this improve more and sooner. Management did provide some explanation, blaming the underperformance on unseasonably high catastrophic losses. As you can see in the graph in the top right, gross loss ratio ex-CAT has trended straight down since Q3 of 2022, while gross loss ratio including CAT has improved much lower. Of course, this graph's duration was selectively chosen, and it wouldn't be a straight line down if you looked a few quarters further back, but I think the trend suggested holds true, and I'll be interested to see how this develops in the next few quarters. Despite the company's intent to slow their growth, they grew more than expected and increased their full-year IFP range by $5 million to $700 to $705 million. This represents only 2.5% growth quarter over quarter for the rest of the year, better reflecting their moderating growth trajectory. Management also improved their adjusted EBITDA guidance by a whopping $40 million, from a loss of $245 to $240 million to a loss of $205 to $200 million. This is an excellent improvement and comes before any impact of Synthetic Agents. It was unclear to me what exactly caused this drastic improvement, but later on in their shareholder letter, they gave some indication when they called out the impact of generative AI on their business. What got me most excited is when they said they've identified over 100 business processes that generative AI can automate and improve, and are prototyping dozens of them already. This is an ability to move fast, and one of those things that gets me really excited about this company. Not only are they moving fast, but it's already having impact on their business, as they said their first generative AI-based automations will make their way into production within weeks, and expect these benefits to be impactful on their financials later this year, as reflected in their adjusted EBITDA guidance change. What's even more exciting is that they said these automations should be even more impactful in 2024 and beyond. This innovation and continuous improvement is a great sign of a highly productive company in the making, and what makes me most excited about Lemonade. Now let's zoom out and take a high-level look at Lemonade. Lemonade has strategic advantages that are afforded to it by being a digital-first company. Being digital-first minimizes overhead costs of running the company, enables the company to better control and improve the entire customer experience, allows them to collect greater amounts of more consistent data to price customers more accurately, and enables scalable growth through multiple geographies. These are some of the fundamental advantages that I think most insurtech companies will have, but Lemonade is capitalizing on these the best. They are focused on creating long-term value in a market where there is so much long-term value to get. Daniel Schreiber, in his blog post about Synthetic Agents, again pointed out that Lemonade could 10x their business and still be just a tenth the size of State Farm. They could again 10x to be the same size as State Farm and still be half the size of AXA, a French insurance company. Lemonade is a leader in modernizing a huge market with tons of untapped growth ahead of them. I'm the most bullish I've been since the market downturn on Lemonade, and I've increased my position slightly since I last spoke about them, and will be looking to buy more as I get more capital. If you enjoy this video, check out my videos discussing the implications of Investor Day or my whole Lemonade playlist in the description below. Thank you for watching and have a great rest of your day.